Hello there, so today's video is going to be about Apple Hospitality REIT, which is a monthly dividend stock which has suspended its dividends in 2020. This video was requested by Earthman in a previous video I created called Why is EPR Stock Fallen? If you're interested in that particular video, I'll put a link to that up above there now. But in today's video, we're going to go through Apple Hospitality REIT. We'll take a look at their investor presentation. We'll look at their financials. We'll look at their share price, how it's performed in the past, how it's likely to perform in the future. We'll also look at what's happened with the dividends, when they're likely to come back, and what levels they could come back at. And I'll run a couple of scenarios for you as well. And then at the end of the video, if you stay around till the end, I will be giving you my opinion on what I think will be happening, whether I'd be buying it, selling it, and at what prices. If you're new to this channel, welcome. My name's Andy, and on this channel I like to talk about money and success. If you're interested in making, saving or investing money, please be sure to hit that subscribe button down below, hit the notification bell, and then you'll get notified every time I release a new video. And if you enjoyed this video and found it useful, please be sure to give it a thumbs up, because that helps spread the word on YouTube. Apparently it helps the YouTube algorithm, which in turn helps me, and of course I do appreciate that. So with all that said, let's dive straight in. The first thing we're going to look at is their investor presentation. So this is a current investor presentation. So we've picked a few key slides from it. So here's the main cover slide. As you can see, it's a September 2020 investor presentation. I'm just going to run through this quickly, some key points of it. So this gives you their company profile. It lets you know they've got 235 hotels with over 30,000 guest rooms, and it's a 99% focused on rooms. It has 13 brands. It claims industry leading brands, including Hilton, Marriott and Hyatt. They've got a broad geographic diversification covering 34 states and 87 markets. So all of that is good. Strong, flexible balance sheet, 40% net total debt to total capitalization, 200 hotels unencumbered. That means with no debt on them, which is good, obviously. This is the key takeaways that they want us to take away from their presentation. So they talk about the cash flow being positive in July 2020. That's obviously good. Again, they've gone on talked about the balance sheet at the bottom there, poised for future growth, conservative capital structure with staggered maturities and no cash burn bolsters liquidity position. So all of that so far reading good. The next slide here shows how it was cash flow positive in July 2020, and you can actually see here on the graph where it wasn't cash flow positive. So you can see how March was terrible, April was really bad, May it was still losing money, June it was partially break even, anticipated property level it says, whereas July, that's when it was profitable again. But as you can see, only just compared to the previous occupancy levels, it's much lower, and it's still much lower. If you look at the occupancy level it is operating at, it's literally around 50%, whereas previously you can see it was 77, 76%. In 2019 was 77%, for example. So it is still way down, even though it is positive. So this next slide here shows you the EBITDA. It shows you basically how it was losing money in April. It made a small amount in May, and the EBITDA was positive again in June. So obviously that's positive data coming out there. This I think is interesting. It shows you how Apple Hospitality compares to other REITs in the same industry. So other hospitality REITs, and you can see their ticker symbols on the screen now. They're claiming the second quarter of 2020 adjusted hotel EBITDA per room, bear in mind this is a per room reading, Apple was actually making $24 per room, whilst as you can see these others were all making losses. And in the second quarter of 2020, the adjusted EBITDA per room, Apple was losing 179, but still that's a lesser loss than these alternative hospitality REITs. So if we're to believe what is showing here, in this sector at least, it's doing good. Obviously, this entire sector in general has been having a nightmare due to all of the lockdowns, all of the stay-at-home orders, the lack of business, the fact that hotels are not getting as much use in general, be that from travel or from business use. That has obviously affected this business industry massively. But what they're claiming is they're performing better than their peers. That's what they're trying to get across in this particular slide here. The key thing really, reason I put this slide on here was I wanted to just look at this top right hand box here where it says portfolio diversified. And you can see it's 58% suburban, 21% urban, 8% airport, 2% interstate, 5% resort, which is like your holiday type thing, and 6% small metro. So it's not dependent so much on the tourism side of things as you would expect, or as I expected before looking at this REIT. When I thought hotels, I thought holidays, but actually that doesn't seem to be the case for this company. This particular company, it's more for the business side of things and the suburban stays. Someone's going and staying, say a tradesman might be going and working in a different state or a different city. They'll stay in a hotel. That's what market this really caters for, as far as I can see. Broad consumer appeal. So here you can see some of the brands on the pie chart there. Nice big name brands. I'm sure you will have heard of them, and they have a broad mix of demands generators, so that they claim they're covering business, leisure, government, military, construction, disaster recovery, healthcare, education, athletics, first responders, insurance. These are all people who would make use of their services or their hotels. This here shows you their geographic coverage, and as you can see, they cover all of the US basically, or the vast majority of, including Alaska, which I see they've put somewhere down south. I'm pretty sure that's up north, but not to worry about the geographics of that. And they have a strong balance sheet, which I will be looking at later. So we'll be looking at the balance sheet. If you've seen any of my previous videos, you'll know I do like to look at the assets versus liabilities ratio. So I'll be doing that later, and you'll see how they're doing on that front. But here, that just gives you infographic type view of the balance sheet. Amendments to unsecured credit facilities. So they've got up to 300 million remaining acquisitions permitted, which I found was quite interesting there. They've also got a discretionary capex of up to 50 million during the waiver period, which of course could be useful to them in a time of cash flow issues. Acquisitions and dispositions. Now this surprised me. I was quite surprised to see that they're selling hotels as well as buying hotels. That, I'll be honest, was a shock to me. I just thought the company would be focused on growing and growing and growing. But apparently not. It sells some, it buys some. So that was, I've got to be honest, I wasn't expecting that. So yeah, they sell some, they buy some, and this is just letting you know what's going ahead at the moment. And this shows you that net sales versus acquired ratio. So you can see where they've been selling and where they've been buying hotels. And you can see basically it's getting less and less. The activity was quite big around 2008 to 2012, and it's tailed off really. And in the past, I'd say 4 or 5 years, they've not really been buying a great number of hotels or really selling a great number of hotels. It's really pretty static in the last 5 years. I mean, sure, they're buying a few and selling a few, but it's not like it was in its earlier days, looking at the infograph here. Now, they concentrate on upscale, room-focused hotels. They claim they align with the best brands, and they give you a list of some of them brands there, so Marriott, Hilton, and so on. This basically shows you what they're trying to do for sustainability. I think every company under the sun now is trying to be energy efficient, but if we're to believe what it's got written here, this is actually doing a really good job of that. If you just look at that right hand side there, the average utility cost per occupied room, full service hotels is normally $9.28. A limited service hotel would be $5.61, whereas Apple Hospitality hotels, it's $4.78. So they have obviously invested in being energy efficient, which will be better for their clients, the operators, which will make them more attractive to be rented from. So that, I would say, should bode very well indeed. So let's have a quick look at the balance sheet. Then we'll look at the ratio of assets to liabilities. Then we'll take a look at the cash flow. Then we'll have a look at the dividends before we start looking at some forecasts. So let's have a look at the balance sheet now. As you can see, in 2015, the total real estate assets were basically 3.6 billion, and they've grown to 4.7 billion in the latest report. However, if we look at that, you can see it was growing right up until 2019, and the value has actually dropped in the latest report in 2020. So the value has gone down there. The cash and cash equivalents, as you can see there, they've now acquired some cash, whereas apparently they had none prior, which is very odd. The total asset level, it rose from 2015 to 2016, and it's not really changed a lot, if I'm honest with you, in the following 4 years. That's not something I would like to see. I'd like to see that growing more than it has been. It's, it's up, but it's not up very much. In the scheme of things, that's not a great deal up. Let's look how its liabilities are doing. And especially when you look at its liabilities have actually grown. So its liabilities have almost doubled in the 5-year period, whilst its total assets have only gone up, a bit, if you like, in proportionate terms. So let's have a quick look now at its asset to liability ratio. So here's its total assets. its total liabilities, we divide the two, that gives a ratio of 2.631. That is actually very, very good. That is a strong balance sheet. So whilst I'm saying the balance sheet isn't as strong as it was, that is a really, really good number there. And just so you know, anything over 1 is deemed good. Over 2 is exceptionally good. So this is very, very good. And its current assets to current liabilities, I make that ratio 3.654, which again is extremely good. So from the balance sheet point of view, the chances of this business going out of business are actually very slim. Okay, so let's have a look now at the cash flow statement. So here's the cash flow statement. Let's have a little look how it's been getting on. So net income, as you can see there, the net income from 2015 was climbing up until 2018. It then fell in 2019. I don't know what happened there. And as you can see in the current year, it's actually making a loss. So that's not good that it's making a loss in the current year, but it is to be expected. Let's have a look at the cash from operations now. That again was climbing up until 2018. It fell in 2019. So 2019 wasn't exactly a great year for them. And then now in this current year, it's just over half what it was in 2018. This clearly explains why the dividend has been cut, doesn't it? Free cash flow per share. There we are. Free cash flow per share. So in 2015, it was it's $1.56. In 2016, it was $1.74. In 2017, it was $1.72. 2018, it was $1.76. That was moving in the right direction. 2019, which we saw earlier, wasn't its greatest year. It dropped to $1.70. And in the current year, it's $1.03. So now let's look at the income statement. We can see the total revenues there at the top. We can see it was fairly static from 2017 to 2019. Not a lot of change. It went up a little bit, down a little bit, but this current year it was right down. What I want to do is actually scroll right down near the bottom, and I'm interested in the per share things at this point. So revenue per share, we can see that there was $4.98 in 2015. By 2019, they'd managed to increase that all the way up to $5.66. And in the current year, that's $4.20. However, the earnings per share, the basic EPS, you can see is a negative number now. And that is why that dividend will have been discontinued. And if you look at the dividend per share, you can see previously, with the exception of 2015, it always paid $1.20 per share. And in a moment, you'll see that was because it was paying 10 cents per month. That was its monthly dividend. This year, it's 90 cents per share. And of course, that's because it's not making a profit, so it can't be paying the profit out. So next, let's look at the historical share price. So between 2015 and June 2018, it sat in a range of between $17 and $20.35 per share. It then fell between June 2018 to December 2018. There was a fall from $19.06 per share to $14.05 per share. It then sat in a range from January 2018 until February 2020 between $15.14 per share to $16.79 per share. And if we look at the more recent term now, after the big drop in March, it seems to have currently stabilized in a range of between $8.65 per share to $11.13 per share. The current share price at the time of making this video is $10.88 per share. So I'm just heading back to the balance sheet now because I just want you to see here the book value per share and the tangible book value. Okay, so if you look at the book value per share here, you can see it was 15.18 in 2015. It went up to 15.78 in 2016. It was 15.53 in 2017, then 15.22 in 2018. So it was trading around its book value previously. Then it was $14.17 in 2019. Again, around the value it was trading at. Currently, or in the last report, which bear in mind was June, it was $13.95 per share. So currently it is trading below what that book value was. So if when the next report comes out, the book value is actually higher than its current value, you could reasonably expect the share price to increase again. So let's have a look at some forecasts. So outcome number one is that there's no dividend until late 2021. I think that's realistic. I think no one's expecting things to come back any sooner, really. So assuming things come back in late 2021, and I'm going to make that same assumption for all of these three possible outcomes that I'm going to go through with you today. So the dividend in this example would return at 25% of the previous level, which would be basically 30 cents per year versus the previous $1.20 per share per year. Assuming you bought it at the current share price and you bought $10,000 worth, you'd be getting annual dividends starting at some point in 2021 of $275.74. Now, if that share price went back up to just below the book value by 2023, because we're assuming here that confidence is still a little bit shaken, so rather than going to book value or above, I've pitched it at just slightly below to be conservative. You would have made a 24% gain on capital plus 5.51% total on your earned income, which would make an average of 9.83% per year total return. Now, assuming it took until 2025 for that share price to rebound to the $13.50 per share level, then you would have made $1,378.68 in dividends, which would be a gain of 24% on capital plus 13.78% on dividends, which would make an average of 7.56 per year total return. So that's my negative, if you like, least positive forecast. Let's now look at a slightly more optimistic view. So if the dividends return again in late 2021 and return at 50% of previous level, this time you're going to make more on the dividends. So the capital gain remains the same. By 2023, assuming it goes back to that $13.50 per share, you'll have made 24% gain on capital, plus 11.03% would have been made on the income of the dividends. Obviously, this is assuming it comes back at the 50%, which would make an average of 11.7% per year total return. Now, if it takes until 2025 for that share price to rebound, then you're looking at 24% gain on capital plus 27.5% in dividends earned, which would make an average of 10.31% per year total return. Bear in mind, this is all with the dividends being cut by 50%, which would be 60 cents per share or 5 cents per month if they go back to paying monthly, which I have every reason to believe that they probably will. And that would be a yield of 5.51% in dividends per year based on the current purchase price. Now let's look at a more optimistic view here. Let's assume that the dividend, when it does return, returns to full strength, so 100% of its previous level, which is perfectly possible, and that could happen in late 2021. I'm not saying that it will, but it could. And if it did, I do think the share price would go higher than the $13.50. I think $15.50 is probably where we could realistically expect it to go to, because I believe actually the book value would increase, the assets would be deemed more valuable because of the higher occupancy rate. And I do believe all of that combined with the higher dividend would push the share price this little bit higher. So if they did bring it back in full, I think rather than coming back at $13.50 per share, I think $15.50 is a more fair level to expect it to go to. But again, bear in mind, this is just my opinion. I'm not a financial advisor. You need to do your own you need to take your own financial advice and do your own due diligence and all that jazz. If it does come back to this level, you're looking at a 42% gain on capital plus 22% total earned in income up to 2023, which make an average of 21.5% per year total return. If that took until 2025 for it to come back, you're looking at a 42% gain on capital again, plus 55.15% in dividends earned, making an average of 19.53% per year total return. And if the dividends did come back in full, that'd be $1.20 per share per year or 10 cents per month. That'd be about 11% yield on dividends on the current share price. So that gives you my 3 possible outcomes there. Now, I'm not saying any one of those outcomes is particularly going to be correct, but it will give you an idea of what might happen. I don't personally own this stock, and I think if you were going to buy this stock, you would have to take a number of things into consideration. You need to think, do you think this industry is going to bounce back? Do you think this company is going to grow? Personally, for me, the reason I wouldn't be really interested in buying this company is it doesn't look very much like it's growing to me. It's been pretty static for the past few years. It's not really going anywhere. So if you were buying this as a comeback play, if you're thinking, actually, I want to buy it for it to come back, that's absolutely fine. Again, you might be buying it because you want a hospitality REIT. If you want a hospitality REIT, according to its slides earlier, you saw it's quite a good one compared to the rest of the bunch. it seems to be boding well. But bear in mind, that's according to its own investor presentation. I haven't actually reviewed other REITs in the same industry to be able to tell you myself. You would need to do that due diligence yourself. It does look fairly stable. It seems to be paying the same dividend for years now, so the dividend's not growing, so it's not a dividend growth stock. So if you're looking for a growing dividend, this probably isn't it. It's probably more of going to be a flat share. Once it gets back to whatever its previous level was, it will probably sit in a band and just stay there, and its dividends will probably just stay there as well. And that is my view on it. So it's in many respects kind of boring, but boring is not a bad thing when it comes to investing, especially if you believe this industry is going to recover. Now, if you believe the industry is not going to recover, then you might want to avoid this stock. This, however, I would say its balance sheet was very, very strong. If you remember the ratio, the asset to liabilities ratio we looked at, they were very, very strong. So it's not likely to go bust anytime soon. It suspended its dividend, which is a prudent thing to do given the lack of income coming in at the moment. Personally, if I was going to buy it, I would probably trade it. So I'd buy it with a view to sell it when it hit a certain price. So I'd maybe, if it dipped, say it dipped down to $8.50 per share, then potentially I'd buy it as a little bit of a punt with a view to sell it as soon as it got over $13 per share. But I'm not really into trading at the moment. I'm more into buying and holding, and this isn't one that I would at the moment, given the research I've just done now, be interested in buying and holding long term myself. I personally think there are better things I could be investing in. I've made other videos about stocks. I mean, I've made a video just recently, which I'll put a link to up there and in the description down below, of a portfolio of stocks that would give you $1,000 per month, pay monthly, and they haven't suspended their dividends, for example. But if I was already holding this stock, I would probably continue to hold it. If I happen to have bought the stock at a higher price, personally, I wouldn't sell out now. It's pretty low price right now. I personally think the industry will come back given 3 or 5 years. So providing you're willing to wait that length of time, your share price will come back, and the dividend, I believe, will be reinstated eventually, probably at the same levels that it was at before. It may come back lower to begin with whilst they build up their cash reserves. The management of this company are clearly very prudent. They're looking after the balance sheet very well indeed. So that sums it up. I hope you enjoyed this video. Please do be sure to check out my previous videos. I'll put a link to some there now. And all that leaves me to say is thanks for watching. Bye bye.